Good afternoon, everyone. I'm Pamela Hastings, and thank you so much for taking the time to join us on another Barometer Readings webcast. It's Fed Week, everyone. So that means that we have a lot of economic data coming our way. So David's going to provide us a brief macro overview. And of course, we'll be diving in and interpreting what that information coming across our news channels looks like. So with that, I'm going to turn the conversation over to our Chief Investment Strategist and President at Barometer Capital, the one and only David Burrows. If you have any questions at the tail end of David's conversation, you can certainly email me your questions at phastings@barometercapital.ca or hit me up on the Zoom link via the Q&A or the chat. And there we go. Turning it over to you, Dave. Good afternoon.
Hey, Pam. Thanks, everybody, for joining in today. We got tons to talk about, so we're going to try and move a bit quickly. I think, a lot of investors are spinning. There's been a lot to think about over the course of the year. I saw a stat today that showed that this year we have had more 7% months up and down than really in any other going back over sort of the last 70 years. So lots of volatility, lots of data points, lots of geopolitical risks. And, I think that investors have found this very, very difficult, especially in the last month or so, because we've had actually a great month in the market up about 13%. Some people have a view that that's a bear market rally. Some people believe we may have bottomed and starting a new bull market. I think that all remains to be seen. One thing we know is that you can't have a long-term rally without starting with a short-term one. And so what we like to do is look inside the market, look at the breadth data, look at some of the internals, and try and figure out what the market is telling us. We all can try and forecast, but the reality is there's 1,000 moving parts, lots of different pieces that matter. And at the end of the day, the market pricing is the output. What is the output after going through all of these machinations? So let's take a crack at unwinding things and take a look at what the market is telling us headed into Fed Week. So let's just start from the very top. We like to talk about the fact that from a macro perspective, 80% of return is get to the right asset class and then find the right neighborhoods within those asset classes. 20% of return is finding very specific securities to express your view. So you can find a great company at the wrong time and get your butt handed to you. On the other hand, you can find from time to time a really great company in a tough market. You can make money, but you're fighting the tide. Our basic backdrop is that we've started a structural or secular bull market, a multi-year bull market in 2013 when we exceeded the highs from 2000. And that's gone on now for just coming up on about 9 years. They tend to last a long time. 1980s and 90s was 19 years. 1951 through 66 was 16 years. They can last a long time. They tend to be 4 steps forward and 1 big step back. The 1 big step back can be painful. But we have to keep in mind that the market's job is to shake us out of our positions and consolidate from time to time. And every single time people think back to the last structural bear market, like in our case, 2000 through 2013, to terrible hard landing sell-offs, or for those that are a little older, the massive sell-off we saw in 1973-74, which was driven by inflation. And so obviously people go back and compare the current market to those terrible calamities. And it's easy to overlay the way that you feel versus what was going on at those moments. Structural bear markets are long and drawn out processes. They do have 2 and 3 year rallies, followed by 18 to 24 month declines. They are very tough periods. So the first question is, are we still in a bull market? And our belief is, yes, we are in a structural bull market. I just draw a very simple 200-week moving average. It tends to be the lower bound in a structural bull market. This is the 80s and 90s. Remember, the S&P went up 18% a year over that period, but there were certainly some tough periods. The 1987 crash, not very much fun. We went through the secular bear market from 2000 through 2013. That was really the end of growth stocks and technology for a long period of time. Actually, the NASDAQ 100 didn't make a new high after 2000 until 2016. And I remember that well because there were lots of folks who wanted to try and pick bottoms in tech as we went through that very difficult sell-off. In this structural bull market, we have been tested a few times. 2015-16 was the Chinese slowdown. down to the 200-week moving average. 2018 temper tantrum into December, the last week of the year was the low. Very, very difficult period. We had the COVID sell-off, which was the fastest and sharpest bear market in history. And of course, we had this most recent sell-off that started really for the S&P at the end of December 2021. We did hit the lower bound 200-week moving average. And over the last month, had a very sharp rally. In fact, the S&P for the month of October up 13%, which is a big number. And here we are headed into the next Fed decision. And the concern, of course, is will the market throw another tantrum? We know that there have been very few months as good as that. October 2022, 13.96% for the S&P 500. There have been a few that have been better and lots that have been very good, but not quite as good. But they tend to be meaningful. So we want to keep that in mind. There's the S&P coming off the lows. We got a great reversal. So an undercut of the June low and a very quick reversal. Markets made pretty good progress. Some would say that the market has upside target, perhaps, of the falling 200-day moving average. There are others who believe that we have gone through a near-term bottoming and we well could be working our way higher from here. I think that all remains to be seen. What we do know is there's been a very good thrust in breadth, and we know that we've had a very strong reaction off the bottom, and we know that people are very, very defensively positioned. Hedge funds had a record short position in S&P futures. Retail investors or individual investors had record put buying coming into those recent lows. We know that asset managers in general were very underweight equities and had higher cash weights than any time going back to 2001. But when we look at volatility really hasn't spiked, showing us we have a hard landing in front of us. Not to say that can't happen, but volatility actually is fairly muted coming off those highs of above 30 and heading back toward the long-term moving averages. This was a real panic. This was the March low in 2020 during COVID, quite different than where we sit today. When we look at a very long-term perspective and look at the periods where you had big spikes, 2018, the COVID low in 2020, the worst part of the sell-off in 15 and 16, 2011, of course, the financial crisis in 2009. At this point, where we sit just does not look like at this point we're headed for a hard landing. Let's talk about bonds. It's been our premise that different than equities, we have been through a structural bull market in bonds that ended in 2020. We think that we saw a generational bottoming at 60 basis points or 0.6 of 1% on a 10-year bond, quite similar to the lows that we saw after the Second World War. After the Second World War, rate yields started to rise. Inflation actually had two big years in 1948 and 49, but then very quickly receded. And while rates rose steadily from sort of 1950 on, actually stock markets did pretty well. The thing we like to point out is what works during a rising rate or reflationary environment is really quite different than works in a disinflationary environment. We all have a tendency to look backwards. People look backwards and say, well, what worked? Well, the number one thing, of course, was real estate. Falling interest rates meant people could pay a higher mortgage or pay a higher valuation on a commercial building, because compared to what you could get for another long life asset, a treasury bond, things look pretty attractive. We clearly put in a low in 2020. And when we look at the long end of the US bond market from the peak in April of 2020, the TLT was down 48% as of last month. That's a massive sell-off. In fact, if we look at it the other way, yields, this is yields falling from 1981 through until 2020. We reversed the long-term trend by breaking these very long-term moving averages. And it's not to say we're going straight higher. My guess is actually the majority of this near-term sell-off is over with. And what the market hates the most is a rapid increase in interest rates. If we quantify it, we've looked at this lots of different ways over the last number of months. This past year was the worst year for the 10-year US Treasury note since 1788. But look, actually, you got a lot of positive returns after that. You had a very difficult difficult period in the late 1940s, but then you got some positive returns. So when we see the bond yield move so quickly, it's scary. We don't know how high yields are going, but the way that it works and the reason the Fed raises rates is it slows things down and it allows inflation to come down and yields to move lower. I think it helps to look at these very long-term pictures. When you look at the aggregate bond index, again, this takes across all maturities and all issuers. Again, it's been a massive drawdown, unlikely to repeat itself in the near term. Okay, so what we know that this year's been very difficult for investors who are passive or just invested in the S&P and invested in the bond market. Actually, it's been about the worst year to have a 60-40 portfolio, equities versus equities and bonds. You can't find a year as bad back all the way to 1931. And we also know that after those periods, it tends to be things get a little bit better. Let's look at commodities. This is the DBC broad-based commodity ETF. Again, structural bear market from 2008 through 2020 reversed. So these asset classes move at different times for different reasons. Why would you want to own commodities? Well, commodities or commodity producers benefit after a long drought because no new capacity comes on. Management teams are not willing to invest in building new facilities for new production. And eventually, demand overwhelms supply. You wind up with pricing. And the problem with commodities is that it takes a long time to replace new production. So we've seen a march higher month by month in commodity prices. And yes, as the Fed started its tightening cycle, we got 4 months of pullback. Last month was higher. We've started this month higher again. It looks to me like that sort of corrective period may be over. We'll debate that. But when we look at the near-term picture, really all we did was we pulled back to the 50-day moving average. Sorry, 200-day moving average. And that would be quite normal. We know that over the last number of months, commodities, broad-based commodities, started to outweigh equities and outperform equities for the first time in many, many years after underperforming for a long time. When that starts, after a long period of underperformance, it tends to go on a long time because it takes a long time to replace production. Part of it is because companies get to a point they're just not willing to invest in new capacity. CEOs wind up being browbeaten by their boards who say, look, you're not going to pour this money away down a hole. We don't want you to spend money building new production. We want to pay it back to shareholders. So let's look at what's happening in the crude market. After a long, very dry spell where energy prices worked their way sideways in a broad range, in fact, we know went negative briefly, finally came out of that range in 2022, consolidated a little over the last few weeks as oil pulled back from 126 to about $80, but recently have reversed higher. In fact, if we look at it on a point and figure chart, it's very stark, higher highs and higher lows, topping out around 124, a corrective period through the months of June, July, August, a weak period often for energy. And we've just broken out of that consolidation to the upside. This bodes very well for energy going into winter. We know during this period, there was a huge sell-off of the US Strategic Petroleum Reserve. We know that there are geopolitical issues with Saudi Arabia and with Russia that aren't likely to change soon. It's likely that producers have the edge from a pricing perspective. When we look at gasoline, it was all Joe Biden could do to bring gas prices lower leading into this election. But here we are now about a week away from the election, and the market's starting to call his bluff, energy prices and gasoline prices moving higher. Well, it's not for no reason. If we look at inventories relative to the most recent years, they're very, very low. They're low for jet fuel, they're low for gasoline, and they're very low overall. We're going to hear lots more discussion about what's going on in the diesel market in the Northeast of the US. If you can't get diesel to drive trucks, it's hard to get gas at a gas station. Real estate. another large asset class. Relative underperformance versus the S&P for many, many months. That makes sense. Rates going higher. Had a little bit of a bounce over the last couple of weeks. Very little to change the picture. And this is one that we continue to be quite cautious on. And finally, let's talk about the dollar. The dollar was on two important covers over the last month after a significant run up. Again, the market hates rising rates that rise quickly, and they hate a strongly, quickly appreciating dollar. We know there's been a ton of hedging taking place by US corporations needing to protect themselves against the risk of a strong dollar, eroding their overseas earnings. And what's happened? After a very sharp rally higher of higher highs and higher lows in the US dollar index versus the pound, the euro, and the yen, we've had our first point and figure sell signal on the US dollar. So we've had yields pull back a little. We've had the dollar pull back. It shouldn't be a surprise that assets that are riskier assets are performing a little bit better. The US dollar not only made a lower high, it broke to a lower low. It broke this support. Now we bounced up underneath. My guess is it's possible the dollar has started into a period of consolidation. Even if the mark dollar works its way sideways or appreciates more slowly, that would be supportive to risk assets. Now, we don't want to be in every asset class all the time. We want to be in areas of the market that have a tailwind. It's our view that we're in an equity bull market, so equities are one place to be. We think we're in a commodity bull market, so commodities are a place that we have to consider. Real estate does not look like that's the case. Looks like it's rolled over. The bond market looks like it's in a bear market. It certainly could have a rally, but not so great. And from a currency perspective, US dollars run a long way. So our job isn't to be everywhere. It's to be in assets that have a structural tailwind. We need our portfolios to be relevant today, given the structural backdrop. We always want to look for change, and we have seen some change recently in the dollar. And our job is to play defense in the absence of leadership. So we've had people say over the last couple of months, why wouldn't we just be 100% in cash? We would say, frankly, there are things that are working in this market. And if the market were to turn, they would likely run very quickly. So we're going to talk a little bit about that. In our process, we have three basic pieces. We run a macro model that helps us to take all of the various places that we could invest and drill down to a universe that have a structural tailwind today. That could be an asset class, a geographic region, a sector, a theme, or a style, frankly, growth versus value. And then we try to find ideas within those universes that make sense fundamentally. And so our research team takes a very broad universe of securities and drills down looking for some very specific characteristics that we know have been present historically in leadership type companies that lead their sector or theme. They're fundamental and technical. This is where our portfolio lies. And the third piece is there's lots of stuff that isn't going to work over time. Our most important job is to make sure that a little mistake doesn't turn into a big one. And so we run stop losses on all of our positions. When we enter a new position, we identify a price below the price we've paid, where if the price were to drop to that level, we've used up our risk budget, we have to step aside and go to the sidelines. We need 20 to 40 positions to build a portfolio. In the O'Neill database that we look at of securities, there's over 100,000 securities we could choose from. So if something isn't working out, make sure a little mistake doesn't turn into a big one. We step to the side. We don't ever average down on weak positions. We only add to positions that work. So let's talk a little bit about that. From a top-down perspective, we're looking for areas of the market where over time, we go from a small percentage of securities performing well to a larger percent. In other words, breadth is expanding. More and more securities are getting a bid. That's healthy. No bear market in history ever took place while you were seeing expanding breadth. On the other hand, when breadth starts to contract, or the percentage of stocks advancing starts to contract, it means that the tide's starting to go out, whether we agree with it or not. It means that risk reward levels have changed. We have to tighten up our stops. We have to stop putting in new positions to the portfolio because now we're fighting the tide. So whether it's at the asset class level or the sector level or a specific geography or specific theme, When bread starts to weaken, we get more defensive and we stop putting any new positions on. So we spend a lot of time talking about bread. Let's talk about it as of today. If we look at the percent of stocks in uptrends, it's been expanding both at the percent of stocks trading above their 50-day moving average, percent of stocks with positive momentum, percent of stocks making new highs versus new lows, percent of stocks trading above their 30-week moving average. Let's look at the actual data today. This goes back to 2006, when the percent of stocks performing well is rising. Well, we mark it out in a column of X's. When it's falling, we mark it out in a column of zeros. We give every security a single vote. So this is looking at the NYSE through a breadth lens. We know when breadth has become very narrow, when you get down to 8 or 10 or 15% and it reverses higher, it's generally been time to put money to work. When you get to a point where 70 or 80% of stocks in the market are rising in price, feels great. The news is generally good. But if breadth starts to weaken, or percent of stocks performing well starts to weaken, it's time to get more defensive. So look, we started seeing deterioration in breadth back in 2021, and as of October, only 16% of stocks in the NYSE were in uptrends. We were in effect retesting the low level we got to in June, and this reversed in and around 10 days ago. And it is expanding since. Based on point and figure price charts, today 46% of all the companies on the NYSE now are making higher highs and higher lows. Percent of stocks trading above their 50-day moving average or 10-week moving average also rising. Hit a low of 6% in October, sitting today at 56% and moving higher. Percent of stocks trading above their 150-day moving average or long-term smooth moving average bottomed out at 12%, as of today sitting at 38% and rising. Over all of these measures, we're seeing improvement in breadth. Now, how long that goes on for, we can't tell you, but it does mean we've been willing to put money to work. Most importantly, percent of stocks with upward price trajectory, positive weekly price momentum, has moved from a low of 8% to 88%. Now, this year, we've had it move from a low level to over 80% twice. Two thrusts. Generally, when the market makes a low, you have an initial low and then retest of the low and a bread thrust higher. From my friends at Dorsey Wright, if we go back over time, looking for the number of times you got over 90 twice in a year, it's a relatively small list. 2002, 2009, 2010, 2011, 2020. When we look 6, 9, and 12 months later, solidly positive in all cases. So we go through a lot of quantitative data on these weekly calls, but we're always looking for clues as to what's happening internally in the market. When we look around the globe, the geographic regions that are in green are showing solid expansion in breadth. The US, Asia Pacific, Europe, Japan, lots of improvement. Now, this is all important because we're coming into a seasonally stronger period of the year. If we look at the S&P 500 index average monthly returns from 1950 to present, you can see that November has generally been a pretty good month. In fact, the strongest month of the year in years where there was a midterm election and in the last 10 years. If we take the past 20 years or since 1950, you can see again, solidly positive. The only month really that rivals it is April. And April also tends to be a very good month of the year. We talked last week about the fact that when you put money to work on October the 30th and take it out April the 30th, in the past, since 1950, you gained all of the return with the market. If you put money in the market on May the 1st and took it out on October the 1st, in general, there was very little return. So we're just coming into the seasonally stronger period. So it's very important that we see these breadth readings improve. And then we have to look at where the leadership is. So let's talk about that next. As of last week, if we took all the 41 industry groups that we track, the average group had 26% of the companies in their group in uptrends. In other words, almost 75% of them were weakening. When we look at each of these sectors, the ones in large caps are showing expanding breadth, meaning more and more companies are performing well. And you can see as of last week, the vast majority were showing expansion. But very specifically, we're seeing strength in energy, financials, Wall Street banks, industrials, transportation and aerospace, healthcare. Okay, these are more cyclical parts of the market. Let's look at it this week. Well, breadth has moved up on average by 10%. In other words, the average sector now has 36% of the companies in uptrends. So breadth continues to improve. And we can see that it's broad-based as almost every sector has seen some benefit, but still the stronger groups, energy, finance, banking, savings and loans, and insurance. Wall Street also fits there. Basic materials, forest products, chemicals, producers. We're down the list here. Metals, precious metals. We've got some consumer discretionary strength. Steel also fitting into materials. So lots of strength. Let's go through leadership. All year long, energy has continued to lead. On each of these charts, I'm going to show the price and I'm going to show the relative price performance versus the market. So you can see that the IYE, the iShares Energy Index ETF, is up 62% on the year, a very tough year. So the oil energy companies making lots of money and getting rewarded. Today, we're closing at a new high, a new relative strength high and a new price high. Now, the energy index is made up of lots of different types of companies. It's energy producers like Hess, which we've talked about over the last few weeks. When you see a turn in the market, you want to see stronger performance when the market makes its second low than the first low. Check. You want to see rising relative strength heading into the second low. And then you want to see sustainable price advances coming once the market turns. Hess has rallied from 104 to 143 in the last month. We've seen that in a lot of energy companies taking out the highs, and in this case, making a 5-year high. ExxonMobil, moving up the ranks of the largest of large cap companies, now $500 billion market cap. And we know that they're generating profit all through this integrated business. When we look at the Canadian oil and gas producers, the XEG ETF, trading better than 95% of companies in the S&P, up sharply on the year, recently rallied from $13 to $18. And this is why, while Biden is selling off the Strategic Petroleum Reserve, which will not be able to go on much longer after the election, these companies are printing money. Companies like Imperial Oil. We talked about some of the mid-cap companies in the energy space, Imperial making a new high. And part of the reason that they're so profitable is there's no new capacity coming on. Oil and gas producers have sharply curtailed their capital spending as the energy index went through a 90% decline from 2014 to 2020. There was no money to spend. Now, these companies are being asked to ramp up their production. But what have they learned? They learned to pay down debt. They learned to pay it back to their shareholders. And as of yet, they are not spending on CapEx and research and development. This is going to make it very difficult for us to see large-scale pickups in supply over the course of the winter, and that may be important as China starts to reopen. So this has implications for other parts of the energy production value chain. We have the producers, we have the refiners, but of course we need the service companies to bring on new production. This is the OIH ETF, moved from $200 to $300, up 50% since the market made its low. This is why it's important for us to find technically sound, strong relative performers leading into market lows and not be willing to sell everything, to hold the things that maintain their strength versus the market. A 50% move. We've talked about precision drilling over the last number of webcasts. Some of the smaller cap energy service companies like Cathedral Energy Services and Secure Energy Services are others that we hold across the firm. So energy producers, energy service companies, and energy infrastructure. AMLP is an ETF that owns energy infrastructure assets. These are yield generating assets, generally pipelines, toll roads in effect, and other infrastructure that are necessary to get energy from the ground to market. Look at the relative price strength since the beginning of the year. So energy continues to lead. Cheniere Energy, which is in the infrastructure around exporting liquefied natural gas, is trading again at new all-time highs. And Topaz Energy in the natural gas infrastructure and production space also. So energy continues to lead. Financials, we've talked about this over the last few weeks. Relative strength continues to rise for the XLF, which is a broad-based financials ETF. Insurance, which had been the strongest group, again this week on market strength, had the biggest jump, moving up several percent over the course of the week. And broker dealers, which are very market sensitive, also moving higher. This is made up of Morgan Stanley, Goldman Sachs, Schwab, and LPL. Now, every market cycle has new leaders, and it's important to find those that bounce well off the bottom, but it's also important to find those that quickly make new highs. LPL will earn $7 in 2021, will earn $11 in 22, and the estimate is for them to earn $18 in 2023. It shouldn't be a surprise that it's making new relative and absolute highs. Excuse me. Okay, moving on. The quick picture is that we're seeing some sharp moves higher in leading securities after long bear markets for their sectors and only a small increase in the overall price of the sector. The first stock in a group to double will be the first stock to double again. And it's important for us to recognize what the relative leaders are. Moving on, healthcare. So in our portfolios, we've barbelled two specific groups. To hedge against inflation, we've held economically sensitive groups like financials, energy, materials, and industrials. On the other side, to protect against weakness in the economy, we've barbelled that against consumer staples, healthcare, and utilities, things that are not very economically sensitive. The healthcare sector has been outperforming since November of 2020. We made new relative strength highs this week, led largely by biotech. And here we go, Vertex, which we've talked about, VRTX, very quickly making new 5-year highs, while companies are starting to just bounce off the bottom. Industrials, rising relative strength since March of 2021, moved sharply higher once the market made its second low. This is a broad-based ETF of transportation companies like Union Pacific, industrial equipment companies like Honeywell and John Deere, Caterpillar, and defense companies like Northrop Grumman. Now, we've talked about aerospace being leadership in this market for quite some time. You can see the sharply rising relative strength. Look at the move that the ITA ETF has had off the lows. But again, when we high grade and go to the strongest securities, there's Lockheed Martin. We talked last week about Northrop Grumman. Lockheed Martin moved from 388 to 486 in 3 weeks. Very strong earnings, and of course, a political backdrop that means governments are going to have to continue to spend. We haven't talked about this one in the past. This is another holding, Science Applications Inc. And this company is in the business of providing IT services and infrastructure to governments and the military. Apparently strong spending there. Outside of the defense stocks, the equipment company is very strong. This is probably on the back of strong minerals pricing and the likelihood we're going to need to re-onshore production to North America as the world's geopolitical setup is changing. Both Caterpillar and Cummins Diesel have had great moves coming out of earnings. So really good strength in economically sensitive groups. The miners, a group that arguably in the past has been very, very volatile. It's been through a long bear market, but has been seeing nicely rising relative strength since November of 2020. Again, has moved very nicely higher as we came off the lows, and the point and figure chart is quite attractive, having broken out of a wedge consolidation to the upside, which tends to mean we get quite a sharp move higher. There's been good strength in commodity prices this week. And when we look at a long-term picture, much like the financials, after a long period of disinflation, put in a bottoming process from 2014 through 2020. We broke out, and in this Fed tightening cycle consolidated, and now we look like we're turning higher. Relative strength looks like it's very strong. Infrastructure is another group that continues to behave well. So let's talk about some basic themes outside of sectors. We've talked all year about dividends being a new home for income investors in a world of difficult bond investing. This is the FDL Dividend Leaders ETF. Relative strength has been moving higher since November of 2020, continues to confirm that as we made a new relative strength high for the year today. Small and mid cap securities have a history of leading off the bottom. They certainly have corrected for a long period of time. Relative strength was weak beginning in 2020, but bottomed in January of 2021 and has been improving since. And value as a theme or a style is showing very strong relative performance, certainly versus growth. So one of the things I look at every single day are the relative strength new highs, those areas of the market making new relative highs versus the market. As of today, the list was fairly small, but it includes the groups we've talked about: energy, aerospace, mid-cap, dividend payers, value. The list is short. Now, things that haven't changed. Technology relative to energy made new relative lows today. A lot of people think that technology companies have come down so far they have to rally. The reaction to earnings was not good. And we are not seeing any major pickup on a relative basis. Consumer discretionary, another large part of the US market relative to energy, continues to be very weak. No major change there. When I looked at the relative strength new lows today, things that just are not gaining versus the market, despite the bounce we've had, a 13% bounce in the S&P. Some key themes stand out. Mega cap growth stocks, okay, the NASDAQ 100, online retail, communications, just mega cap as a whole. So this list has been consistent. Large cap tech continues to weaken. Large cap communications continues to weaken, even though there are a few securities in here that are behaving better, like Iridium, which is one of the holdings in the firm, satellite communications. Large cap growth and mega cap growth continuing to weaken. So look, this is going to be a very important time for investors, and we've talked about this all year long. The investing world has become very polarized in being passive, holding the broad market, not being targeted, not making active decisions. And for a long time, 40 years, we had falling rates supporting structural themes that benefit from falling interest rates. 2 weeks ago, we talked about the fact that we needed to find securities that had higher relative strength when the market made its October low than it had in June. In other words, things that didn't go down again when the market went back and retested the lows. Here's a list. And on this list, we include a couple of global markets like Brazil, which we own in our macro fund, biotech. We have things like aerospace. We have things like small cap value. We have things like energy, of course. Other countries like India, which are leading. We have resource producers that pay dividend, the Gunner ETF, upstream natural resources. We have healthcare. We have a number of the themes that we've been talking about. The reason that this is so important is if we did the math, okay, communication services is 7% of the S&P. Consumer discretionary is 11% of the S&P. There's 20. Technology is roughly 30% of the S&P. Now we're at 50% of the S&P. 50% of the S&P is performing very, very poorly. The best performing part of the market is energy. It's 5% of the S&P. So this is a time when we have to pick our spots, and being a tactical investor could be very, very important. There could not be a more hated sector in the market than energy and more underowned, yet it's generating almost all the returns on the year. When we look at where we sit as of today, across the firm in Barometer, 22% of our holdings are attached in some way to energy. That's producers, it's service companies, it's pipelines, it's infrastructure. But this group has a solid tailwind. Financials over the last month has become a larger weight at 15%. For those that have been following along, we had a good sized position in short-term government bonds, which we said was a source of cash should we start to redeploy. And when our breadth models turned up, we started to redeploy. It's down to 9%, but it's generating over 4% yield. Industrials are roughly twice the market weight at 14%. Healthcare has been rising. Consumer staples, also defensive dividend payers, have been rising. At the other end of the spectrum, real estate is a 0% weight. Technology is a 3% weight. Consumer discretionary is a 4% weight, way below market weight. And materials is now close to a double market weight. So it's a time we have to be targeted. Now, I can't tell you how the market will react after the Fed releases its news. I can only say that markets tend to behave in the way they were set up coming into an event when they exit. Markets are a discounting mechanism, and there's a lot of smart people trying to figure out where the pieces will fall in the world going forward. There's some very clear leadership all the way through the year that continues to lead. And we believe we continue to be in a structural bull market for stocks. So we're long commodities and basic materials. We're long the more economically sensitive parts of the market. We are long the defensive sectors that pay us dividends, and we're avoiding big parts of the market. Now we're into the reporting period. October is a big month. 68% reported already, and in the first half of November, we have 22% of the S&P reporting now. With 300 companies having reported, the average company has had a sales surprise of 2% and an earnings surprise above estimate of 4%. So things are moving along. Last words. It's been a very tough start to the year. And in October, we put this up to say, look, I know it's been difficult, but keep in mind the worst, most difficult 9-month periods tend to be followed by a lot of green. The market's a discounting mechanism. I'm not saying there is clarity on the economic outcome for the year or for next year. I'm not saying that there is clarity on the Fed's tightening cycle or other central banks around the world. And we certainly don't have clarity on the geopolitical risks, which are why the market was down 27% at the worst point. But we do know that internally the market is behaving constructively. We do know we're about a week away from a midterm election, and the months following a midterm election have been solidly positive 100% of the time. I know there's been a lot of volatility in the market. You have to go back to 1937 to have had 5 months with 7.5% moves up or down. That's a long time, and it's trying for investors. But we have to try and be empirical about this. We continue to have an elevated cash weight, but we are more and more invested as leadership is showing its face. And if things get difficult, we will get defensive because that's what we do. We've had a history of playing defense in tough markets. And frankly, we're very happy with the returns so far this year given how difficult a year it's been. So with that, Pamela, if there's any questions, I thought I could get through it quicker. Apparently I didn't. Thanks everybody for joining. Pam, is there any questions out there?
Yes, actually, we just have one this evening. Francois wants to know your thoughts on whether dividend yields will be able to keep up with the rise in inflation. I think we have one other question following that, so bear with me. So
okay, so it's a tricky question because it's a two-part question. What you're asking, will they be able to keep up with inflation? And that assumes that inflation is high and will remain high or go higher. And I don't think that we can make that point. What I do know is that rates started to rise in the late 1940s and rose until 1966. Rate increase periods or reflationary periods tend to unfold over a very long period of time, and they come in fits and starts. We've had a fit. Like there's been the worst one-year return going back to 1788 for bonds. I think it's unlikely that that repeats. I think more likely, like at the end of the 1940s, after a bout of inflation, the supply chain will slowly come back into balance. We know that inventories across the system now are pretty chock full, and we have a different picture than we did 8 months ago. Inflation across a whole host of different measures is starting to come down, even the sticky ones like rent. So it's possible that we could get some respite in inflation over the next year. And so that would be good for all dividend payers. But if we believe that rates will slowly move higher over the next 10 or 15 years, which we do, the cohort that will do the best are the companies that don't pay the highest dividend, but the ones that have the best dividend growth. So we tend to be looking more for companies that have an improving ability to pay, companies that have a history of raising their dividends consistently. And there's a whole pile of companies in the market that I think are much more attractive than fixed income, because we'll get the rising dividend yields and we're likely to get appreciation in share prices. So yeah, I think there's lots of places. And I think that, listen, the world is looking at all the data out there. And for whatever reason, dividend growth oriented ETFs are solidly outperforming the market. So people are voting with their wallets.
thanks
Any
so
other
much.
questions, Pam?
Yes, actually, we just had one slide through. Sebastian wants to know whether you think the semiconductor space is getting close to a bottom here.
You know, this is a tough one because let's see if I can throw a chart up here. So that's the XSD semiconductor index. As you can see, this is an equally weighted index. If we were to look at the SOXX, that's an index that is on market cap weighted. Relative strength just continues to be sloppy, and I am unconvinced. You got to remember that if we pull the lens back, this is a group that has had just a massive rally since 2020, but since the beginning of the structural bull market. And this has already been a more substantial sell-off than at any point. So I would need to see some improvement here. Now, there's some areas that look a little better. The chip equipment companies like KLA-Tencor look a little better. AMD looks better than the group. But remember, when a sector or theme has sold off like this one has, you've got a lot of unhappy shareholders who are looking for their opportunity to get their money back. We would tend to look for groups that have bucked the trend through a difficult market, because it takes a lot of conviction to buy securities in a falling market. And if things have bucked the trend, there's probably good fundamental reason for it. It just can take a long time for a sector that has been so in favor to get back into favor. Remember, I said when tech stocks topped out in 2000, they didn't make a new high until 2016, 16 years later. There was a lot of money to be made in other sectors during that period of time. So no, I don't think it's time to buy semis yet. I think you got to be careful. They can certainly bounce, and they can certainly have a good bounce. But I think it's going to take time to build a bottom in a group that's been hit so hard.
Dave, we've had one additional question come through. Stephen in Toronto is looking to find out whether your comments towards the end of this afternoon session suggests that perhaps there should be a focus on investing in the income pool that Barometer manages. Is that a place to be focused on at the moment? I know that all of our clients have diversified portfolios within our pool weightings, but specifically, any comments on the income pool there?
So my view is two things. I think if I were to pick two major themes that we've talked about for some time, is if we are in a long-term period where bonds will underperform. And to put a point on it, from 1950 through 1966, bonds went up 1.6% a year. That includes the interest payments. And inflation was 1.6% a year. So it gave a 0% return over 15 years. In that same period, stocks went up about 12% a year. So a huge outperformance. The best performing part of the stock market during that period were dividend growth stocks. And the mania that came at the end of that period was the mania around the Nifty 50, which were the 50 companies with the best ability to grow their dividends. And by 1970s, they were trading at 70 to 90 times earnings. So as many know, our income portfolio can go anywhere, but it is highly focused right now in dividend growth stocks, because I think there's a mountain of money that could slowly come out of the bond market and into things with a rising stream of dividends. So that's an important theme. But I don't want to dismiss the commodity theme, which is not going to be a place we're really that focused in the income portfolio. We'll do that in our equity portfolio and our macro portfolio. So they're both important themes. They're both just getting going. They both will have drawdowns, but I do think that they're both important. The income portfolio will have, relatively very low volatility.
Thank you so much, David. Well, that concludes the questions that we've received from our viewers this evening. And as always, we thank you guys for taking the time out of your day to join David and I. And with that, Dave, I'll leave you with the final word as always.
Yeah, look, folks, thanks so much for joining us. I'm really happy that we've had you with us. It's been a very, very tricky year. And, I think it's going to stay tricky. It's going to be an interesting week this week. The Fed's going to give us some more of their thoughts. I think it was interesting that Australia and Canada raised less than expected. I would expect the Fed to raise 75 beeps, but they may signal that they may slow down a little. The net of it is there's a lot going on. And so we're happy to do these webcasts weekly. We're going to keep on doing them. If people want to follow in between, I do post a fair bit of stuff on Twitter at Barometer CA. And as things happen, we try and keep people abreast. And if something important happens in between, we'll be out with messaging in between. If you got questions, don't hesitate to give us a call, shoot us a message. We're happy to answer them, whether you're a client or not. But we appreciate you taking the time and look forward to seeing you again next week. Thanks, Pamela, for all your help.
Thanks so much, David. Bye, everyone.